This video is going to show you how you can make money trading the Forex using Fibonacci ratios. There's two main types of Fibonacci's: retracements and Fibonacci profit targets. Fibonacci retracements show you low risk places to buy in the direction of the uptrend on a short-term pullback. Fibonacci profit targets are where the market usually will move to as the trend continues and then stall or reverse. Let me show you an example here. The market is moving from the bottom up, and you want to draw your fibs on here. You left click on the chart using leveragefx.com's Fibonacci tool. Left click and drag all the way to the top. So this shows the 38.2% Fibonacci pullback, the 50%, and the 61.8. I usually recommend to new traders the directional move has to be 25 to 30 pips or more, and you want to buy the 50 or 61.8% fib pullback. So let's look at this particular example. The market pulls right down to the 61.8% level. If you would have bought it to 50 and scaled in it to 61.8, the market continues its uptrend. See, the market makes a move up, pulls back, and the fibs give you a low risk place to buy in the direction of the trend in anticipation of the trend to continue. Now as the market goes up, you'll see our Fibonacci profit targets are then displayed. This is the 1.382 Fibonacci profit target. Most times the market stalls at this level. Strong trends will go to the 1.618 level, then reverse. If you're a counter trend trader, using the Fibonacci profit targets, using LeverageFX's properly set Fibonacci levels, is one of the lowest risk places. So you could get into your short right here at 1.3195 and scale in again up here at 3204, and you can see the market pulls back about 15 pips. Goes up and tries to test the high again, forms a double top, and then pulls back about 20 pips off the high. So this Fibonacci system lets you get into the trend on a pullback. You buy here, the market goes up here, you exit your longs, and you consider going short if you're a counter trend trader. This trade right here found about 40 pips up, and the counter trend trade found about 20 pips on the way back down. Let's look at other examples. Here the market's in a strong uptrend. It obviously is a failure because the market explodes down, right at 10 o'clock, right during news. You want to draw your fibs on here from the highest high to the lowest low. And as we scroll into the future, we want to get short here at the 50 and the 62% level. And in this case, it didn't actually hit the 62% level. Our short right here at 31.65 fell about 20 pips as we are anticipating the downtrend continuing, which it does. Let's go look at another example. Here's an example where the market shoots down, comes back up to the high, fails to break out higher, comes back down again, fails to break out lower, tests the high again, and then finally breaks down and makes a lower low. So now we can assume the trend is down. You want to wait for the first consolidation area to draw your fibs. So you draw it from here to here. And because the market's not able to retrace up to the first 38% level, I suggest not buying the first 1.382 fib profit target. You want to buy the second one, because this is a sign that the market's not even strong enough to retrace back up to even the most minimal retracement levels. So if you're a counter trend trader or you're trading with the trend, you want to hold on, and this is an excellent place to get out of the trade at. Let's see what happens. The market just touches this area to the pip and retraces back up about 40 pips. So for those of you who are short, it gives you the absolute perfect place to get out of your trade. You would have caught 100% of the move, and you can trade counter trend there very safely because you can risk 5 or 10 pips, and in this case the market went up 40 pips your way. When you risk 10 pips and you make 40 pips and you're right 50 to 60% of the time, you make a ton using the Fibonacci tools in the Forex. Let's look at another example. Here's another example. The market shoots up, fails at the high, and comes back down, makes a lower low. We can now assume the downtrend's in place, and we want to scroll over, and if you draw your fibs on here from the high to the low, notice the market retraces right up to the 38% fib level and stalls. This is a relatively risky area to get into trades, but it does work when the market's really weak. Let's scroll to the right and see what happens. breaks down and is going to a lower low, and you can see the market stalls right at the first Fibonacci profit target. If you're short right around here, this is your first profit objective, and in this case you made about 36 pips. And if you're a counter trend trader, you can wait for this level to get into a low short-term counter trend trade. You would have bought here at 31.45. The market went up about 20 pips. Actually went up about 45 pips. So that's a low risk place. If you risk 10 pips down there, again, in this example, you made about 45 pips while risking 10. And these Fibonacci profit targets are about 60 to 70% accurate in my testing. This concludes our Fibonacci analysis tool. If you'd like to see more free videos, go to our website at leveragefx.com. That's LEVERAGE.
December 15th, 2006. This is your daily video technical briefing. You're looking at the Euro USD 15-minute candles just before the US session opens up at 8 a.m. Eastern Time. And today we have CPI on the calendar. This is very important to the Fed. They're looking for any signs that there might be inflation left in the economy. And if there isn't, well, maybe they'll consider lowering interest rates. If there is a sign of inflation out there, well, maybe we'll stay paused for a while. Okay, so CPI is a great way to see if there's inflation at the consumer level, and that's what's happening today. So at FX Bootcamp in our live sessions before we traded the news, what I did is I brought up the NewsTrader Pro database, and we started looking at the historic empirical data of past core CPI. We looked at times when the actuals were better than consensus, less than consensus, and equal to consensus, and got a general idea of what's happened in the past 18 CPI releases. Well, guess what? It came out as 0.0. We expected 0.2 like we always do, so that's less than expected. So we got to pull up the less than expected. Find out that 0.0 occurred May 18th, 2005, and you look over here, you can see that price spiked about 41 pips and then totally collapsed, giving us an absolute total reversal. You can see this is where it opened, went up 41 pips, and then actually came down about 50 pips, actually close to 60 pips. So what we can expect is price to go up for a while and then down, complete reversal, not a retracement, but a complete full reversal. That's what happened in the past. Let's see how that worked out today. Looking at the charts, you can see stochastics is pointing down, MACD is pointing down, and the overall trend is down. So you'd hope that eventually we'd have an opportunity to sell to the short side. Let's map that out first before we see what actually happened. I map this out. I do a fib study. You can see we just got shy of a 382. So a 382 retracement, you're thinking, well, certainly a 1618. And we can see that that's down there near 130.76. So let's plop that down there. You can see a 1382 is kind of where we are now. We started out with the 1382 at 131.01. Taking a look at pivot points, the M1 is 90. That's a key reversal area as well, and that's pretty close to the psychological level, and it's pretty close to the 1382. So why don't we plop that down on our chart, and that could be a possible target later on if price starts heading down. But we don't know what it's going to do at this point because of CPI data coming out. Okay, but at least we kind of have an understanding. This should head down. Everything is pointing that it's going to go down. But you know what? An object at rest tends to stay at rest. An object at motion tends to stay in motion until a greater force is acted upon that. That is new information in the market, and we're about to get new information, core CPI. Okay, so that could change everything. So for now, let's assume down, but let's wait for the key numbers to come out. Boom. Okay, let me zoom in. And, well, let me get this a little bigger for you. And you can see this is the end of the first 15-minute candle. Now, realize from the launch of the news, we're expecting 41 pips. That NewsTrader Pro helped us understand. We overlapped it with past data. Past data was way back there. Last time we got 0.00 as a core CPI number was May 18th, 2005. So you map that out, it says this is going to spike 41 pips from here and then do a total collapse. So if we're at 41, let's just call it 81, and that's right about there. Okay, and so what happened last time is price hit that level and then totally, completely reversed. So let's see what happened. Boom, right there. This is actually where the news broke, and back here is the movement just before the news. So the actual break was right around 40, and sure enough, we hit that 131.81. We expect that to be the top. So if this does break, let's say 132, then of course we'll just keep going. But I'm expecting it to reverse here. Also, not only is it at the top, it's also the 200 EMA, so it certainly can hold. And then I think if you study yesterday's range, that's also a fib level. But anyways, let's move forward and let's see what happens from here. Okay, it's kind of wimping around, right? So it looks like that could be the top right at 81 as we predicted. What you want to do from here is look for an entry. What I'm going to do is I'm going to use the wick from this candle to put us in. So if we get a lower low, we already have a little bit of a lower low. So if we get another lower low and this dips back into the Bollinger Bands, that's going to put us in. If we short, first target's going to be this congestion area somewhere between 30 and 40, so let's check it out on the pivots. 46 is a pivot point, so why don't we make that the first target? Okay, the other side of 46 is 11. That's way down here. That's going to be our second target. And third target is down there, as we already know. M1 is 90, and that's pretty close to some fib levels and stuff. So first target 41, second target 11, third one 90. Okay, and only if we get the signal to short, and the signal to short will be a break of this support area that we've identified. Boom, you're in somewhere around 70. First target achieved, second target achieved. Uh-oh, where's this? Let me move this. You can't even get it on the charts. It's moved so fast. And look at that. We've hit it. Seems amazing, right? Look at our target at 90 was achieved. Our target at 11 was achieved. Our target at 41 was achieved. 1, 2, 3. We hit them all. Okay. It's pretty straightforward. We used empirical data to find where the top might be, plus it's a 200 EMA, plus it's a fib level, plus it's a central pivot point. So there was many reasons why that 131.80 area is going to be key. Sure enough, it did turn, and just like the empirical data showed in the NewsTrader Pro database, not only would we expect a retracement here, in fact the retracement is likely to be a complete reversal. And it panned out, and we just traded along the pivot points. The M1 reversal pivot point is at 30.90, so I always get out there, and you can see that it was a bottom once, a bottom twice, a bottom 3 times, a bottom 4 times, a bottom 5 times, bottom 6 times. So you know, it was nice to get out, and that seems like we picked the top and the bottoms today and traded right in between. Got a conservative entry, and we went on aggressive for the exit, and you know, in at 70, out at 90. Hey, not too bad. Let me also show you something. I'll clear these primitives. If you do a study here, let me move the chart so you can see the candles a little better. If you do a fib study from the top of this range to the bottom, from the core CPI announcement, you'll see that this area right in here, around 17 or 18, is very important. That's a 786 Fibonacci retracement. If that 786 is broken, then you know for sure that this is a reversal, not a retracement. So usually when you're using a fib study, as price comes down, you're expecting it to bounce either here, or you know, at any of these fib levels. If it bounces at that level, these are retracement levels where price will retrace back into the prevailing trend and then head back up in this case, right? Well, this last fib right here, the 786, if that breaks, there is no retracement, and what's occurring is a full reversal. And you can see as soon as we broke that area, it was straight down You could have shorted at roughly 20 or 18 or let's say 15. And this went straight down to our first target at 90. Hey, there's 25 pips there, just based on the fact that you should have known that if the 786 broke, it's definitely an opportunity to short because it's not a retracement, it's a reversal. So straightforward use of empirical data to understand the market based on the actual release of the core CPI data. We did not scalp the news. We did not trade immediately after core CPI was known. We actually waited a good amount of time, did our research, did our homework, found out what happened before back in May 18th, 2005, and it overlapped perfectly with the 200 EMA, it overlapped perfectly with the central pivot point, and overlapped perfectly with a fib retracement. So it looked like it was going to head down. Then we used a swing load for an entry, got in around 70, used pivots and fibs down, 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 down. 3 points, nothing but net. It was a fantastic day. Good way to end the week. Okay, so today is Friday, December 15th, 2006. This has been your daily video technical
brief. General rule
brief.
of thumb is when you're above the white pivot area, you want to go long, and when you're below the white line, you want to go short. You want to look for shorts. Because if the market's underneath the average price of the previous day, it's likely to go down. If it's above the white line and above the average price of the previous day, it's likely to go up. That's one rule that most pivot traders use. Because so many traders use the pivots, they also make tremendous support and resistance areas. Notice how this midpoint, this is halfway between the pivot and resistance point 1, which you can't see on the chart. The market opens up and is relatively weak and can't get over this midpoint. Normally you would expect the market to find support right here at the pivot. It pretty much chews right through that and goes right down to the first support level. Now once that's happened, you want to trade on the short side, so you want to wait for the market to retrace back up to the pivot or another resistance level and get short. And so you get short right here, and the market comes back down and goes right through this level. This is right during a news time, and your next profit target is either the midpoint between support 1 and support 2 or the second support level, which is exactly where the market went to before stalling and finding support. Let's look at another example. Here's the next day. You can see the market was already in a downtrend. It's consolidating here sideways, and it finds support at this first midpoint, which is also, the low of this little range it's in. And once the market breaks down this level, it finds a little bit of support here. It gets a little bit of a bounce. These are 15-minute bars, and then breaks down and goes down to the next midpoint level. And look, almost to the pip, this pivot level is a support area. So if you're looking to find areas to trade counter trend, the pivot zones are wonderful areas to get into relatively low risk trades. You can see the market finds support here and bounces, comes back down again and bounces. This is a 20 pip move, 20 pip move, and it's just consolidating here. Goes down to the next pivot area and finds some more support. As you can see, the next day it goes over the pivot area. One would expect the market to go up to the pivot. That's what typically happens. When the markets have been in a downtrend for 2 days, they're likely to make a run up to the previous day's average price. And when that does not happen, it gives you a very big clue that the market's likely to go down. And as you can see, the market's kind of consolidating here at the midpoint. And once this level gets broken, it's a very safe short to get into, and this is your first profit target, and here's your second profit target. And you can see the market just kind of chops around at that second profit target down there. Let's go back in time and look at some more examples. Now here you can see the market opens up underneath the pivot, breaks out above the pivot, goes right to the first midpoint level, which is resistance level, almost to the pip. It's perfect resistance. Market comes back down and is consolidating. Once it breaks down through the pivot here, you would expect it to go to the midpoint or the first support level. And the market goes right to the first support level and finds perfect support right there. You can get in at this level and buy, or wait for a double bottom, which is safer, and buy, and use the midpoint or the pivot as your profit target. Let's scroll into the future and see what happens. Market goes right back up to the pivot. That's a nice 40 pip move you got off of buying the first support level. And the next day, because the market rallied, found support, didn't even go to the second support level, and broke back and closed the day above the pivot, the next day the market's likely to go up. You can see that the pivot's down here. Our rule of thumb is we want to go long when the market's above the pivot. And so that's exactly what happens. Look, it goes up, finds resistance right at the second resistance level. This is resistance level 1, which it finds support on, and it breaks out. This is a pretty safe place to buy right here. And this is your profit target. You scroll into the future, you can see this midpoint here acts as support, and as long as the market's above this midpoint right here, you know, you're looking for the market to try to go higher. Once this midpoint here gets broken, you're looking to short. Watch what happens. You go short right here, and you can see the market pulls back down. Here's your first profit target. You know, you might consider getting out at the midpoint here, where the market may pull back to the pivot. Look, it pulls right back to the pivot, you know, within a pip or two. And if you would have got short up here at 45, you made about 35 pips on that short. So now we're in a little consolidation zone. If it goes above this first resistance level, look for the market to go to here or here. And if the market breaks underneath the pivot, we want to go short. It holds resistance here. Found resistance here the first time and then the second time. So if we break the pivot, we're likely to go lower. Okay, so we go short. And this is one of those things where if you go short and the market immediately comes back up above the pivot, you get out of your short with a tiny loss. That's what's nice about the pivot trading system. When you're right, you make a lot of pips, and when you're wrong, you can lose 5 or 10 pips max. You never want to lose more than 10 pips trading this method. And so the market, you know, goes up the next day. Here's the pivot. It's likely to find resistance here and come down, but if it doesn't, we want to go long. And you can see, look, the market found resistance here, pulled back 10 pips. You could have made 10 pips the first time. And if it can't go back down to this midpoint level here, it's likely to break out above this level, and we want to go long when it breaks above 31.30. Look, so here we go long, 31.30, and the market shoots up, and you can see it shot up about 20 pips. We just made 20 pips there. And it broke out above the next resistance level. It's likely to go the next, and it does. If you got out of your trade here and bought this pullback here, you could have exited here again, or once it broke that level, looked to get out of your trade right here at the next resistance level. And this market's very strong, goes up to the next midpoint and kind of stalls. You know, the markets oftentimes either touch these levels or they go, you know, they're so volatile they go a little bit through it but then consolidate. So basically, if you wanted to short this market, this is a resistance area. Once the market goes underneath 31.80, you can get short with a profit target of here or back at the pivot. And you can see, look what happens to the pivot. Pivot acts as support. You can buy this area because most traders who use and trade off the pivots look to buy right at the pivot. The pivot is the most powerful of all these levels. And you can see the market finds support here and immediately goes back up 40 pips in a very short amount of time. Very low risk, safe place to buy. Now it's finding resistance here. You can go short once it breaks the low of this little consolidation area. With anticipation, it'll go back to the pivot. And look what happens. The market's not weak enough to go back down this much. That's your first clue that it might go higher. If it breaks above 31.50, we want to go long again. Next day opens above the pivot, so we want to go long. You can see it tries to go higher and fails, comes back down. We want to basically buy the first time it touches the pivot. So the market pulls back. We get in right here at 31.50 because the market the previous day was above the pivot. It's above the pivot today. The trend's up. We're buying dips to the pivot in anticipation that the uptrend's going to continue. And that's exactly what happens. We just see a 30 pip up move here. You could get out right here at the midpoint or hold on to the next resistance level. In this case, we just made it close to 50 pips. And you can see the market kind of stalls here. If it breaks out above this level, it's likely to go to the next resistance level.